Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Already looking down the barrel of Christmas. Spring is certainly here, and the spring selling season absolutely underway. Chatting with people across the property ecosystem over the last couple of weeks. Very vibrant, particularly down in Melbourne. Very competitive. I was only speaking to a buyer's agent just the other day, and he was saying 35 offers on a particular place in Frankston. Most of them through buyer's agents. So every man and his dog's out there at the moment trying to look at and capitalise on that Melbourne market. But we might be able to talk about a little bit of that today. But I've got in the studio someone who you may be familiar with. He's been in and around property investment, this buyer's agent space for quite some time. He recently, last year, won the award for the REI NSW Buyer's Agent of the Year. He's also got a couple of books around, which you might have read. Lloyd Edge, who is the founder and managing director of Aus Property Professionals. We're going to chat through his story, what's going on, how he sees the world, and maybe what's next for Aus Property. Lloyd, how you going?
G'day, Phil.
Good to see you,
really
mate.
well.
Have we actually met before? I think maybe at a function or an event or something.
We have met at some functions before, but not in this studio, so really great to be here.
Yeah, no, good one. So you're Sydney-based?
I'm Sydney-based down in the beautiful Shire, which is not too much worse than where you are here.
Yeah. So you've always been around the Shire? Is that where you sort of grew up?
No, actually. I've only been down there about 7 years when we bought our home down there.
Okay.
Prior to that, I lived in the inner west with my wife.
Okay.
And then dabbled in a few other areas around Sydney. But prior to that, I actually came from the country out in Orange.
Oh, you're an Orange guy.
That's where I grew up.
Yeah. Is that would have been before it was a cool winemaking place, I imagine?
Yeah, they had orchards back then. So everything was orchards. A lot of hail storms that basically just damaged all the orchards. So all the orchards, all the farmers had ended up going into wineries.
Yeah, they were made a few bucks now, no doubt.
They were pretty wealthy.
It's supposed to be pretty good wine growing out that way. I don't mind an orange. You don't?
Yeah, it's really good. And my cousins are actually into to wine out there, so it's in the family.
Okay.
But we love going back there. I've still got a little bit of family there, but we always go there and visit a few wineries and bring back a few bottles and stuff.
Yeah.
Love it.
Did you grow up in town, or you grew up on
a farm?
Property?
Yeah, about 10 k's out of town.
Okay.
So I grew up on riding. I think I could ride probably first sat on a horse when I was about 2 years old. Okay. I remember falling off and hitting my head, and growing up around motorbikes and things like that. So that was kind of my life.
It's all good fun. Yeah, different upbringing, very different to God's country, they call it, down in the Shire. But so how long's Aus Property been going for?
We've been going for about 12 years now.
Okay.
Yep. So we've been around a bit. Started just with myself. And now we've got about 25 staff.
Okay, you got 25 team members. Wow. And are they from all walks of life? Are they property investors first, and then Aus Property Professional team members second, or you like them investing in property?
Yeah, so I do like them investing in property. So all our team members do invest in property. However, for me, it's about really getting the right people on the team rather than just specifically looking for property investors first. So often we'll get people that might have a real interest in property, and then train them up, get them on board, and they start buying property. Other people, particularly the buyers agents, have already got some properties, and then obviously come on board and work there, because our team's spread with buyers agents and property analysts, research analysts, admin staff, support staff, across different states as well. So we're not all based in the beautiful Shire. I've got a team in Brisbane and in Melbourne and in Adelaide, and a couple of overseas support staff as well.
Wow. Okay. And this has just evolved over the last 12 years. You never sort of started the business thinking that you're going to end up with a large team like that?
Well, no, it's a funny story there, because when I started, I had actually so I was originally a teacher. I'd been growing my portfolio gradually as I was teaching, and I built up a passive income with my portfolio that was basically about the same as I was earning as a teacher at the time, which is about 100K. That allowed me to walk away from teaching at the time, and then I kind of set the goal then that I wanted to get in and help people with property, and it was a bit of a funny joke there with my wife, because I was always talking about property at home with her, and she said, "You really need to meet clients in cafes and start talking to them about property, so I don't have to listen to you talk about property at home." So that's kind of how that evolved in a sense. But when I set up the business, it was more about trying to, I guess, if I could earn the same sort of income with, through being a buyer's agent that I was earning as a teacher, I would have been happy. So that was basically the goal at the time. I had no business acumen at the time, probably, and no goals to grow the business. So that's kind of happened organically over the years. But yeah, initially, the first couple of years it was just myself and eventually an assistant, and then my wife came on to join us as well, and we grew from there.
And what sort of teaching did you do back in the day?
So I was a music teacher.
Okay.
I taught from basically year 3 up to year 12, instrumental. Yeah. So I wasn't in the classroom. I was basically teaching private music lessons, which I played the trombone, the euphonium, which is probably something that people have not heard of before, a bit of piano, and conducted the school orchestra and band and stuff.
That's pretty cool.
Some good opportunities there. Took the kids on some international music tours and things. So very much a different lifestyle to, I guess, what I live at the moment.
And how did you, or why did you start investing in property? Was it a sort of a strategic objective to replace your income so you didn't have to be a teacher anymore, or was it more of an organic thing?
It was probably a little bit of both, but I did realise after a while that the income that I was earning as a teacher wouldn't be enough to provide real security for me in the future. And originally, the way I was earning my income as a teacher was through peripatetic teaching. For people who don't know what that is basically you're just getting paid per hour for the work that you're doing. I wasn't actually on salary. Okay. So it was a bit of an inconsistent income. And I thought while I was enjoying doing that, I wasn't going to provide a stable income for my future family. And at the time, I didn't own any properties. I didn't have a family. I was single, but I knew I wanted to set myself up for the future. So I started to invest from that perspective. And I think initially, I bought sort of a couple of properties and things probably weren't going so well because I was doing what I thought you should be doing, which was, buying in, good areas near the water and all that kind of stuff. And I was buying in Sydney, but I felt really negatively geared, and it was actually costing me more to own property. And I was thinking, what have I done? And essentially, but over time, I developed some strategies and understood around what I could do to actually add value to properties, what it meant to buy in the good locations that would actually help you to create real value through your portfolio.
So what size portfolio did you create while you were on a teacher's salary? So
I created a portfolio of I had about 11 or 12 properties.
On the teacher's salary?
On a teacher's salary at the time.
Good going.
Now, obviously, admittedly, these days that would be a little bit more difficult with the property prices and things. So I'm not sort of advocating, everyone can just do that now. But I was at the time earning between sort of 50 to 70K as a teacher. And by the time I'd finished teaching, I was on about 100K. Okay. That's what I was basically earning. But really, when I first started, I thought I'd missed the boat at the time because there's a lot of conversations around these days about property prices and how it's too expensive and people wish they had invested 10 years ago. Well, I bought my first property almost 25 years ago, and even then I thought, oh geez, if I bought this before the Olympics, before the property boomed, before the market boomed, I would have done better. And I think I've missed the boat. So that conversation's always been around, essentially. So
it's funny you say that. I was chatting with someone yesterday, and they made the point. So we're recording this podcast in North Sydney. He goes, you can't get a freestanding home within 20 kilometres of where we are right now for less than $2 million. And you sit there and just go, how do they become $2 million for that? And we sort of said, in 10 years' time, we're going to be talking about how cheap it was.
Absolutely.
Back then. And getting into the market now for $2 million, probably that's quite a lot of. It's a big check you got to write. But the inherent sort of cyclical upside value of properties says that if you make the right decisions at the right time, you should be able to create wealth. So when you were a teacher and you created the portfolio, what sort of properties did you have in it at the time? Where were they? Where were they located? What sort of assets were they?
The first property I actually bought was in Rockdale, which is just near the airport here in Sydney, and I bought a 1-bedroom apartment. Now I did something that I probably don't really advocate for people to do these days, but I bought that to live in. So I didn't actually buy that as an investment. I bought that to live in. And then I had that for a couple of years and then decided that I should sell that and get something a little bit bigger until I went and took some advice from a mortgage broker. And I realised that if I kept that property, I could actually afford to buy another property and actually start investing. So I kept the Rockdale property, and then I went and bought a property in Ingleburn.
Okay.
Which is out in
Campbelltown.
near Campbelltown.
So what sort of time was this?
So this was in the early 2000s. Okay. So my first property I bought was around 2003, 2002. And then a couple of years later, I bought in Ingleburn. I then bought...
you would have been buying in Ingleburn in 2002 for about 200 and...
It was about 225,000 or something like that. So, and even that property, when I sold it in around about 2013, had made a lot of, probably about tripled in value at the time. I probably shouldn't have sold it then. I still see that as one of my mistakes, just even selling it then.
So from Ingleburn, then you just propelled from there, did you? Where else did you buy?
Yeah, I did. So I bought. We bought a couple of other properties in Sydney. I ended up having one in Leichhardt, and one in Alexandria as well. But propelling away from that, I ended up going interstate. Buying one in Toowoomba as well. Yeah. But one of the big things I did early on was when I felt that I was in a little bit of debt and things weren't going too well because I had 3 or 4 properties in Sydney. I was pretty much maxed out, feeling quite neatly geared. I looked for better ways to be able to do things. And that's where I figured that I actually need to try to create some value and have better cash flow on properties. And that's where the whole idea of positive cash flow came along. And I went and built a duplex. So I went and bought a block of land. And that was in Armidale in New South Wales, because there's a few Armidales around. There's one in WA and one in Melbourne. But
this Armidale's in country.
This is in country New South Wales. So I built that duplex, and on completion, I had it subdivided and then revalued, and the amount of equity in it was twice as much as what I was earning a whole year as a teacher. And that's where the light bulb kind of went off in my head, because I was earning $70,000 as a teacher. I had about $141,000 equity in that property, just based on the fact that I'd built it for less than what the end value was. And for me, adding value, and also because it was dual income, I had positive cash flow coming from it.
So you bought the land, you put the duplex on it, and then you split the title after it. So did you tear that up beforehand, or did you do it subsequent to it?
I did that subsequent to it, yeah. So I bought the land. I mean, the first thing because it was the first project, I didn't really know what I was doing. So I bought the land, and then there was a few hiccups through council around doing what they needed, and I had to find a builder I could trust and everything like that. So I didn't really know what I was doing, and trying to seek a little bit of advice here and there. But doing the so I strata titled that property, and that's where I made that equity gain. But that propelled me, because the equity I made from that I used to put a deposit on a property in Brisbane, and then also get into another property in Newcastle. So I started to propel my portfolio from that point.
And this is why you're still working as a teacher?
This is why I'm still working as a teacher.
Okay.
Yeah.
Wow. So how big is your portfolio now? Can you give a sense for it?
My portfolio now is sitting at there's about 18 properties in there at the moment.
Yeah, okay.
And its value is about 30 million. But I'm at the stage, so I'm still buying properties when it suits the strategy, but I'm also selling down and paying down debt and everything essentially. So we've paid off our family home, we've paid off our holiday home, a couple of other investments are debt free now. So for me, in my stage of the portfolio, we're sort of consolidating everything now. Sort of been through that acquisition phase and holding, and now consolidating that debt as well.
And the purpose for creating wealth through property, other than because you can, like what's the outcome you want?
For me, it's never been just because I can. Yeah. It's really been for for a greater purpose. So it initially started off, like I said earlier, to try to create a better future for my family, essentially. So for me, having the ability to be able to, pay for our kids to do things. So, go to good schools, for example, have a nice lifestyle. We've got a house, waterfront house and things like that. So that kind of stuff I wouldn't have been able to afford just by, living on a salaried teacher, I guess.
How old are your kids?
6 and 4.
Okay.
So they're very young.
They're young. So I was going to say, do they have appreciation for what you're doing, but not quite yet.
Not at the moment, no. In fact, they keep asking me, my friend has a nice house. Can we go buy a house like that? So,
how do you think you'll frame it when they're sort of old enough to understand it, rather than just, accepting that as normal to have, property investor parents?
Yeah, the biggest thing for me is keeping them humble, but also really educating them, because one of the things that's missing in the education system is really educating people on educating kids on finance and how to set themselves up for the future. So that's what I really want to do with our kids. So it's really about not just handing them a portfolio of properties, but teach them how I did that and what they need to do. So when it comes time for them to buy their first property, we can help them out with some deposit and things, but they need to, contribute to that and understand the work that goes into that.
Still got to do
essentially.
that. So, I completely agree with you. There is really an opportunity for greater financial literacy for kids, and I think a lot of parents, I might be generalising here, they think that's the obligation of schools to teach them that. I think sort of financial literacy and education really needs to start at home and needs to be cultivated at home.
Yeah, I completely agree. Yeah. And being a former teacher, not everything is the responsibility of schools. Your parents do need to share some of that, responsibility and teach that, to the kids and stuff as well. But getting back to your question, apart from putting my family in a good position, it's also about what you can do for the greater good. So I like donating to charities and things. So I've been a regular contributor to things like the Cancer Council. And that, I guess that started because I lost my dad to cancer probably about 28 years ago now. And I also contribute, being a musician in the past, I donate to scholarships for kids to have instrumental lessons through summer Sedfords and things like that.
Very cool.
We also donate, and this is something that I do through the business, through Aus Property Professionals, donate to certain charities. So we're currently donating a portion of our client fees to some work we're doing in Kenya, where we're paying for kids' education over there, building schools and things like that.
Wow.
Which is something we've just recently
started. Is that directly
started.
or is that through a...
That's directly.
Okay.
Yep. So, and that's something I've just recently started, something that has been a goal for quite some time. And I'm currently in discussions with Virgin Unite, which is Sir Richard Branson's not-for-profit organisation, to contribute, with the good work that they're doing with similar stuff as well. So it's about trying to do things for the greater good, because I think, to be honest, there's a limit to how much money an individual needs. So for me, it's not just about creating wealth just for the sake of creating wealth, but it's about what you can do with that. And also, I guess, having that generational wealth, so the kids, our kids will understand what's being created, but they can pass that down to their kids and so on.
Well, you think about, building, and there's families now all over Australia, which is sort of third and fourth generation, property portfolios, right? And they may have, and a lot of them are migrant stories, by the way, who bought a whole bunch of places in the less desirable parts of Sydney, for example, and now those portfolios are sustaining, and are quite wealthy. So, it's nice to be able to start down a pathway. This is the issue everyone's talking about now, is that, home ownership in the capital cities in Australia is going to get harder and harder because of the retention. So there's an obligation, I think, to educate and inform people who are inheriting these things.
Absolutely. And, and just on that, so I guess I've kind of broken that chain a bit in my family, because my parents didn't invest at all. My dad, he was a business owner, but, we weren't wealthy or anything. And he never had any debt on anything. So he basically said, if you couldn't afford to pay cash for it, don't buy it at all. He bought a house for $10,000 because he had $10,000 in cash in his bank, right? Yeah. These days, that kind of thing doesn't work, particularly with the fact that it's about 13 times the annual income to buy property. Incidentally, that particular house I'm referring to, that he bought for $10,000 back in the 70s, is now worth, we've still got that in the family, and that's worth $2 million now. Yeah. So for people listening, that's the idea of compounded capital growth.
Yeah, it's a mindset thing, and generationally, you sort of, your post-war and baby boomers, they're still very conservative, a lot of them in their mindsets and attitudes towards property ownership. And this is this like dichotomy that everyone still talks about, this maybe romanticised view around home ownership for, say, Sydney, or it's the same exists in Melbourne. You buy a quarter-acre block in the suburbs and raise a family there, and you get a mortgage paid off and in 25 years and then live debt-free, right?
Yeah.
There is still a romanticised view around that. Whether that's practical in this environment, you need to have a different attitude and aptitude towards debt and have a comfortable, relationship with it, because it can be difficult.
Yeah, well, you do. And one of the things that I do advocate these days is rent vesting, where people can rent where they want to live, because generally people, particularly young home buyers, are not going to be able to afford to buy. If they want to live on a place like Bondi Beach, or even in this beautiful place in North Sydney here, they generally can't afford to buy a property like this, but they may be able to afford to rent here, and then they can get on the property ladder by buying investment properties where it makes sense, around the country, and get on the property ladder, build up their portfolio, and some of those properties can be used to get them maybe their dream home a little bit later down the track. And that's essentially what I've done, and that's one of the reasons why I wrote my books, was to explain that journey and how, if I can do it, so
How
can
can
you.
be done. Yeah, and conceptually, I like the idea of. I don't like the term rent investing. I've always, for some reason, disliked it. I don't know why, but conceptually, it makes a lot of sense to people. And this is the challenge that you have right now, where the government's thrown all these incentives for first-time buyers to get with a 5% deposit and a 95%. Mortgage they can get in home ownership using these things, but there's obligations around it. The idea, the pub test is that you live in those. Yeah, it's not for rent investing. So, I know a lot of younger investors now, and to be fair, I think the average age first time buyers now in their late 30s, right? They're doing actual sums going, I'm going down that pathway and use government schemes, or I can do it the other way, which is, renting where I want to live and investing where I can do it. And often the numbers, look better to not go down the government incentive route.
Yeah, so it's great to see the government trying to do those things, but I do have those conversations with clients just about every day where we do that comparison around, okay, if you buy where you want to live, and let's say they do live in Sydney or Melbourne, for their budget and using that 5% guarantee, they might just be able to buy an apartment. We look at the potential long-term growth of that property being an apartment, as opposed to maybe buying a house with good land value in an area where they could afford to get that, and that we look at a different area. We could be looking at Perth, could be looking at Brisbane, maybe a regional market, and then it's usually those 5% homeowner grants. Those sort of markets are not going to stack up as well as just getting out and getting a good investment property.
Yeah, there you go. So do your sums. But let's talk about your book. But before that, let's go to a quick break. Stay with us. Back in a moment. Welcome back, Phil Tarrant, host of the Smart Property Investment Show, chatting with Lloyd Edge over at Aus Property Professionals. Now, Lloyd, you've been at this for a little while, teacher, now a buyer's agent. You've got a large team. I was just looking around and I saw some of these accolades online, REI, New South Wales Buyer's Agent year 2024. One thing I did notice is that you used to be part of PIPA, the Property Investment Professionals of Australia, and you're no longer with them. I don't know if something's happened there. Well, can you give me a sense for that?
Yeah, absolutely. Yeah, so we it was involving a staff member of mine a number of years ago that we were buying a property, and something happened between the buyer's agent and the real estate agent, where somehow the rental appraisal was changed, or that wasn't quite factual between what it should have been when it was handed over to the client. I was actually away at the time, but I had a discussion with Pippa over that. However, being my business, I've got to take responsibility over things that occurred with that. So I parted way with Pippa at the time. But needless to say, I guess as a business owner, sometimes you do have staffing problems and issues with getting the right team members on. And obviously, I've learned from that experience. But that's something that I needed to sort of take on board and deal with at the time. But that's going back quite a few years now. Yeah.
So a setback, but you've sort of readjusted things and changed those practices there.
Yeah, well, we didn't have that as a practice. It was more that was something happened with with that particular staff member, and had to deal with that at the time. Get rid of that staff member, deal with the consequences of PIPA, and move on from from that perspective.
The business ownership isn't always beer and skittles, right? You got to deal with these things.
Well, that's right, and I guess that's one of the things of when you're starting out and it's just you sort of can control everything, and as you grow, you grow in your team, and you're hoping you do your best to try to get a team that you can trust and everything like that, and sometimes things don't always go 100%, but when if things don't go 100%, then I've always got to own that. So that's I owned that straight away and dealt with that, and we moved on. But like I said, that was probably, I think it was about 2019.
Oh wow, a little while ago
when that popped up.
How'd you go through COVID? The COVID period, was that once the sort of the madness and rationalisation of what's happening, it was good times to be in property.
COVID was probably it was a really good time, for us.
Noting it was tough for some people, but
well, it was a really interesting time because when COVID first occurred, and it was that came, all those lockdowns occurred about the same month that I just had my book released, my first edition of Possibly Geared, and then all of a sudden COVID came, and I thought, what's going to happen? All the phones are going to stop ringing, and I don't know what's going to happen. And I only had a fairly small team at the time compared to now, but I was reassuring my staff, and I said, we've got enough money in the bank that you'll still be paid even if we don't buy any properties for people for the next couple of years. So for me, I was quite comfortable deep down that I had what I was comfortable with. I had a good portfolio that was so I was thankful that I built up a portfolio that was paying passive income, and that the business had been successful. But our income and my family's income was not relying on the business because I had the portfolio. So that's a good lesson for people to have a second source of income, which is why I advocate obviously building up that passive income. But during COVID, once people sort of settled into that, it became a really good time for a lot of people. I mean, people on JobKeeper, and some people couldn't get loans, but other people who could get finance. There's some really good opportunities, and of course, when you look back at what happened there's a massive amount of growth. So we went through a period there. We ended up having to take on more staff because of the demand, and did really well. But it was an interesting time because you couldn't really inspect property, but there were some. It was in place that like real estate agents and buyers agents could inspect properties, but you could only have sort of one person in the house at the time with a real estate agent. So there are a few rules like that in place. And then sometimes it will, we might have been travelling somewhere. We might have been travelling to Newcastle or down the South Coast to inspect a property for a client, and then halfway down there, the agent would call and say, "Oh, you can't come because the owner's got COVID or the tenant's got COVID." So would stop and turn around and come back. So
topsy-turvy time, but it's seismic shifts to the economic climate or how we're living. It's not the first time it's going to happen. It's not the last time it's going to happen. And it's that vulnerability of the strength of your position when stuff like this takes place, and being well covered at all times.
We just had to adapt, and we adapted. But COVID itself was really interesting. I mean, we had a baby born. Our first son Riley had born just before that in 2019, and my wife Renee and I and Riley were going to cafes, but we weren't allowed to sit down on park benches because you'd get fined. The cafes were closed, but they were open for takeaway. So we'd get our coffee and we'd have to stand up on the footpath and just drink our coffee or eat our yogurt. So there's a lot of great times that we'll be able to tell our kids in the future.
Yeah, and look, and I do know it was a very tough time for a lot of people. So sort of putting that aside and all the health complications around it, but there's a lot to be learned from it, and that was that really sort of practical application most people had towards change and how quickly we changed, not only as a nation and how the government sort of advanced, but how quickly Australians adapted to it and found ways to manoeuvre within it. There's a lot to be learned from that, and they're the type of mindset traits that you really want to have active and operating at all times.
Absolutely.
Be responsive and reactive to change. But again, when we've gone back into this mode where change is a lot slower now, and there's a lot more anxiety around change. When you're forced, it works well. So with Positively Geared, then, so you wrote that and delivered it. Was it 2009?
Yeah.
So the catalyst. What was the catalyst of the book? You just wanted to tell your story? Was that the idea?
Pretty much. Yeah. It wasn't written as a marketing. Like, it wasn't like an ebook or something that you stick on your website because you're trying to attract clients. For me, I think I just had an epiphany one day, and I thought, I've actually got a story to tell. And like everyone's got a story to tell, but I actually thought, I've been there. I've been a teacher. I came from a family that didn't have much money. When I was at uni, I had no money at all. I was literally living on ice cream cones for lunch. When I was a kid, I got hit on the head with a cricket bat, which started me with a lot of migraines and things like that. So, and that I really struggled through school and through uni and even as a teacher from that perspective. And then building up my portfolio and then getting into property and getting the business going. I thought I've got a bit of a journey to tell, a bit of a story to tell, and it's not about sort of marketing things. It was more about saying if I can do it, so can you. And I sort of talked about all my backstory about what's happened and how I the resilience that I've been able to obtain in my life, which is partly because of my parents and partly because of some of the things that have happened in my life that I've had to sort of get over. And then, I obviously talked about the strategies I used to build up my portfolio, but also the mistakes I made. Yeah. I bought a property in a mining town once because I thought that was the best thing.
Which mining town?
It was in Blackwater, Blackwater, Central Queensland.
You still got this house?
I do. I do still have that. It's a bit of a reminder of what not to do. So I sort of keep that there. I don't know whether it's a good thing keeping that there.
Is it negative equity or is it?
It's not really negative equity now, but it's look. I paid about $260,000 for it, and I think it's probably worth about $240,000 now. Okay. But given the fact I've had it for 15 or 16 years, but the story with that is that I bought it because I was looking for a positively geared property, and this I actually went through a buyer's agent at the time. So the buyer's agent shouldn't have bought me that property, but I guess he bought me what I had asked him to buy me. And the property.
Buyers, they don't say the name, but there's a buyer's agent still at it. It still exists. Or
I'm not sure exactly what he's doing.
All right. Yeah, right. Yeah, okay.
So
no worries.
But
let that go.
but the property was on the market for. Well, I got it for about $260,000, and it was bringing about $800 a week in rent. So, as a young property investor, I thought this is what I want. This is positively geared property.
Yeah.
But of course, I didn't realize at the time about all the fundamentals. These days, I understand all the things about the amount of industries you need to have. When you're looking at things like retail, education, healthcare, manufacturing in a particular economy. A mining town doesn't have any of that, so there's nothing to support the town. So at the end of 2012, the mining company moved out, and all of a sudden. Instead of paying $800 a week in rent, it was paying about the next family that moved in was they could only afford about $190 a week. So it just completely went back. So that's a bit of a story, and I still have that property, and I talk about that in my book about what not to do. So because no one who's ever been successful at something hasn't, we've always had setbacks as well. So that's an important thing to notice.
It's a lot of money, $200,000, but it's not too painful a lesson. You could have done that a lot worse elsewhere. And this is the point around positively geared properties, and I've got a bit of a thing on this at the moment because you jump onto social media and there'll be someone telling you they can build you a positively geared portfolio that's going to give you $150,000 passive income a month, and I listen to this and I go, that's not going to happen. But I preface that you could do it. You'd need to buy a lot of properties in areas which might not necessarily give you the capital growth.
That's right. There's a bit of risk there, but there's a bigger thing to that. So for me, it's to achieve that passive income, that positively geared portfolio. It's not about you could buy a property now and even have something with 8 or 9% yield on it, and it's going to be a little bit positively geared, but it's not going to pay that income that you want unless you own 100 of them, and you can't really buy 100 properties anyway. So for me, it's about buying good value assets that are going to get good, strong capital growth. There needs to be an exit strategy in the future where you look at how you can pay down some of that debt. And that's why, when I'm working with people now, I like to surround them with an accountant and a financial advisor, and we have roundtable discussions on, what we can do with this asset, how we can dispose of that. If this makes, if we look at buying a property that's going to get, maybe 7.2% annualized compounded capital growth over, 10 years, and, it's going to be worth this much in 8 years' time, we could, sell this property and it could pay off the debt that's still owing on this one, because the only way to get real passive income is to actually have low debt, unencumbered properties. My portfolio at the moment it's got an LVR of about 40% on it.
Okay.
Now I started off buying properties with 5% deposit. Back in the day, banks were lending you 95. I think when I bought Blackwater, I borrowed about 110% because I just cross-securitized it. All the things that I tell people these days not to do.
Yeah.
But it's not just about buying, really high yielding properties and then buying lots of them to build up that passive income. It's really about, buying solid assets and then, looking at when you want to achieve that passive income and then looking at how you can actually get rid of that debt on the properties, because that's how you're going to achieve that passive income. Yeah. So it's not just about, and like even for me, like some of my properties now are negatively geared, but overall the portfolio positively geared. So it's about a positively geared portfolio. But as for how long it takes to do it, even when I was a teacher, it took me maybe about 12 years to do what I did. And
it doesn't happen by chance or accident. You're going to need to be very deliberate and strategic.
You do need to,
and you need to know what your outcomes are. And for a lot of people, chasing a positively geared portfolio quickly is probably not the right strategy for them. You want to be operating for a period of time if you can sustain it from a cash flow point of view. If you're in an accumulation phase of you're inherently going to be negative if you're borrowing at 80%, even up to 90% for a rapid expansion of your portfolio.
Absolutely. And that's a conversation I'm always having with people because, people are wanting if they're borrowing at 80, 90%, sometimes they borrow at 100%. If they're borrowing like equity from another property and then they're leveraging 80% loan for the property, it's effectively 100%. And then they want to be positively geared on all of that. It's not going to happen.
No.
So I need to have these conversations and let them know, well, this is the plan and this is where you'll reach that positively geared point on this property, all going well. But that's why it's really important to, map out a strategy and understand that plan and how that's going to work. And people need to realise that, if they want to get in and just buy positively geared property that's going to cover itself from day one, and every property's got to be like that, it's probably not the best plan for them because the properties themselves may not be the the best assets.
They might be
essentially.
positively geared, but they're not going to give you capital growth. And, being a property investor to get a little bit of positive income on a lot of our properties, you're not going to go anywhere quickly. So it's really an individualised thing, whether or not a portfolio is positive gear or negative gear. Your portfolio for me might be negative, might be positive for someone else.
Yeah, and
it
the
just
other
depends
thing,
what your VR is.
Absolutely.
Yeah.
And also it depends on, because once you get yourself in a position where you've got more equity, then you can buy like properties that are positively geared. Like as an example, I bought a property in Manly West in Brisbane last year for my own portfolio. Now it's positively geared. Now for most people, you can't buy a property in a capital city that's positively geared. But because I put down a 50% deposit, it's positively geared straight away, right?
Yeah.
But you can only do that when you've got you've been at it for a while and you build up that equity, and you got that equity as cash that you don't owe money on.
And it's the concept of how you deploy your capital and what return you want on that capital. And you can have 100% positively get property pay cash for something, right? It's going to be giving you an income that you're going to pay tax on, right?
Yeah.
And again, this is another consequence to it all. If
That's
you're
right.
positively geared, that means that your cost to maintain a portfolio is less than the revenue it generates. So guess what? The tax man will count that as positive income.
All these are things that I talk about in the book.
Yeah.
And like when I meet with people, we discuss strategy. We look at that. So it's really about, okay, when do you want to? Like I try to get to understand what people's long-term goals are, their financial goals, their lifestyle goals. If they've got kids, are they paying for kids' school fees? Because private schools can be expensive. They want to be able to fund holidays. Look at what they're trying to achieve, and then we look at that time frame of when they want to achieve something by. If they were looking for a passive income, is it a 10-year, 15-year time frame essentially? And then we map that out. And then I basically meet with clients sort of every 6 months to keep working on that strategy, for that, because, they need to understand how they can get there. It's not about buying really high yielding properties now. It's about understanding, how they can get there in 10 years, 15 years, the type of assets you need, and having a good team around you. And that team does need to include an accountant, a mortgage broker who understands financial strategy, because that strategy also needs to consider the entities you're buying in. Should you be buying in a trust? Should you be buying your own name? Should you be buying in a company structure?
And the strategy is important. Let's just drill down a little bit more into it. We'll just go to another break. Stay with us. Back in a moment. Welcome back, Phil Tarrant, Smart Property Investment. And please, you might have seen me every now and then asking for those reviews. I get a hard time from our producers here if I don't say, hey, send your reviews and give us 5 stars. So if you like what we're doing here, and we've been doing this for 10 years, it's the 10th year of podcasting for Smart Property Investment, please do it. But Lloyd Edge from Aus Property Professionals talking about strategy. What I imagine a lot of your clients are introduced to you through your book, which is called Positively Geared, and you get a copy of that. Where do you pick up Positively Geared from? All good bookstores, is that the best place?
Yeah, they're available in all good bookstores.
Yeah.
They're even available in some of the bad ones.
Okay.
But
you're not the discount binge yet, or
we'll talk about. I've got a special thing happening for SPI listeners as well, so we can talk about that. But in terms of the bookshops, they're available in on Amazon, obviously, in Demings, QBD, Collins, or all the bookshops. They're available at airports, so all over the place.
Do you still get a kick when you see your book on a shelf somewhere? Yeah, it's just been there for so long now.
I got to say I've probably always taken that in my stride. I haven't really. I guess to some extent it's a little bit surreal. But then at the other point, I kind of just see it and move on. And I do like to pop into my local bookshops just to sort of see, because I obviously get a list from my the publisher about how many books have been selling.
Yeah. Is it still selling well?
It's still. I mean, we've just been through the best month ever. Like August was the best month ever for it, so it's selling more than ever. But I get a list from the publisher about how many are selling across the country in all the bookstores. But I still like to pop into my local, whether it's Morano or Westfield, and just check how many books are in QBD, and then pop in the next week to see if there's still the same amount or whether they've sold or whatever.
Do you put your books in front of the other competitor books? I used to do that when
that wouldn't
Property
be
used to be a magazine. I sit there and put it in front of
I do turn them around so you can see the front cover though when you're there, because you can just see the binder. So I do like to turn them around, but I wouldn't sit them in front of the competitor books, because the competitor books they all need a good go as well.
Nah, do it. I reckon do it. So, but imagine a lot of people are introduced to you and you're approaching your strategy through the book. Do they come to you saying, I want a positively geared portfolio? Is that typically where it starts?
Generally not, and I think it's because they've read the book and they understand what I talk about in the book. So they don't really come talking about positively geared portfolio as such. They more come and say, I've read Lloyd's books, and I'm looking to get into property investment, or I've got half a dozen properties and I feel stuck because I've got clients that are first home buyers. One of my clients is 35 properties, right? So we've got quite a diverse range of clients that we're working with.
Do they like having 35 properties? Like the bigger the portfolio, the more the headache.
Stressed all the time.
Yeah. But you got to be careful.
But it might be his work
Yeah.
that's keeping him stressed because he's not. I mean, he could be financially free, but he's still working because he might like working, but he's working to cover a lot of these properties.
It's
as well,
negative geared, right? What sort of properties has he got in there? Are they sort of blue chip type stuff?
Most of them are blue chip.
Yeah.
A mixture of probably newer properties for tax refund, depreciation because he's got a high income, but also I think I built a couple of duplexes for him, and we've done a couple of renovations. So a real mixture, and also regional properties. So I think he's got some across Victoria, New South Wales, and Queensland, and South Australia, in capital cities and regional markets, which is kind of what we need to do because even my portfolio is balanced between sort of half in the cities and half in the regions. Otherwise, I wouldn't be able to get that many properties anyway.
Yeah, good.
Getting back to the we always diverse, don't we? So people they basically just come along and they say, read my book and I'm interested to talk to you about my strategy. Sometimes people, because my email address is in my personal email address is in the book, people actually write me an email sometimes and thank me for writing the book, but then also tell me a bit about the story, and I love getting those emails, and I try to reply to every email, and they tell me about where they're up to and maybe some of the hardship times they've had in the past. I get a lot of teachers and nurses and people who can relate to my story a bit and things. And, I like to jump on a call and just talk to them about where they are and how I might be able to help them. And
I guess,
that strategy.
The origin story of teaching, commendable profession, by the way. And I don't think our teachers get paid enough alongside with nurses and first responders. Something for the government to have a look at, I think. But it's an authentic story that a lot of people would probably connected. So I can see why you've documented that inside of the book. You mentioned you can make it available to Smart Property.
Yeah, so with Smart Property Investment listeners, we've got a special thing going where we've got free giveaway. Okay. So we'll give you that website link. But that's basically all you got to do is pay for the postage. And in fact, I think that the amount we're charging for postage is probably less than what it's actually costing me for the postage as well. So you get a copy of Positively Geared for free. And if you want both books, I think we'll throw in the second book for. How
do you check it out? Just go to your website and then put / something or other?
We'll put a link
in the show notes.
In the show notes because it's available from the website, but there's a special link for SBI listeners, which unfortunately I don't have on top of my memory right now.
We'll put it in the show notes, and remember Christmas is just around the corner, so it's a great stocking filler, and what a nice. So I find that during that Chrissy period is when a lot of people actually do a lot of reading and thinking, and it's where they can step out of work mode and
I do that. I do a lot of reading. I'm about to go to Fiji for a couple of weeks, and I plan to just read.
Sounds pretty good.
Yeah.
You don't read property books, do you?
I don't read property books. I like to read entrepreneur books and books from other business owners that I aspire to and things like that.
Do you still play? Do you ever pick up the old trumpet?
Trombone.
Trombone.
I do play a little bit. I've been playing in a band. I haven't for a couple of years ago. My team actually wanted me to come here and play something at the start of the show.
You should have. Maybe you can get you to re-record the jingle for coming into the Smart Property Investment Show.
So, but maybe a little bit rusty because I haven't played for a couple of years, and there might be some musicians who are listening to me. So, so I thought I won't jump in and play that this morning, but might be an idea for next time.
Well, thanks for coming in, Lloyd. I've enjoyed catching up, mate, and no doubt I'll see you in and around what's going on in real estate and property investment. So, thanks.
Definitely.
What's the best way to track you down, just in general? Just Google Aus Property Professionals.
Yeah, just come to our website, auspropertyprofessionals.com.au. But also, people can find us on Facebook. We've got a group. It's called Basecamp Property Club.
Okay.
And that's actually started when our client. I went to Basecamp. That's where I got the sort of the name for that. So that there's a lot of information and strategies that we talk about there as well. So again, that's completely educational. We don't sell anything there. Yeah. And then people can also follow me on Instagram and on LinkedIn.
Okay, you can see photos of him reading books in Fiji and a couple of.
Yeah, well, maybe I'll put something there as well. Nice. So love for people to just follow me on socials and jump online and get one of the free giveaway books because they're normally like $35 in the bookshops, but we'll give it to you for free.
All right, do that. So there'll be a show note wherever you're tuning to this. Just look through the notes there and click on the link and go and check that out. And great way to fill those those Christmas stockings. That's Lloyd Edge, founder and managing director of Aus Property Professionals. Thanks for tuning in. Remember to check out smartpropertyinvestment.com.au. You can follow us on all the socials, and that's how you can probably keep connected with what's going on. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.